Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some financial results from a parent and its subsidiary. We're speaking, of course, about NCB Financial Group for its first quarter of 2026, as well as Guardian Holdings Limited for their fiscal period ended fiscal 2025. Now, both groups would have reported somewhat contrasting fortunes. Let's take a look at what those results look like and what investors might expect in the coming months ahead. Turning firstly to Guardian for its fiscal 2025 period, well, the group would have reported an earnings per share figure of $6.61, which was a whopping 80.6% increase from the $3.66 reported in that prior comparable period of 2024. Now, take that with a pinch of salt. Those results were impacted by a very significant one-off gain on sale of one of its business operations. Excluding that, earnings from continuing operations would have improved still a very commendable 4.7% from $3.63 to $3.80 per share. Driving that performance was the insurance service result, up 35% from 886 odd million to just under 1.2 billion. Net income from all activities improving 2.7% from 2.095 billion to just about 2.15 billion. Ultimately, profits attributable to equity holders improving that 80.3%, again impacted significantly by that one-off gain from 850 million to just over the $1.53 billion mark. Now, when we take a look at operating profits and results by segment, we can see that there was consistent improvement at the operating level, nonetheless, across most of GHL's major operating segments. Life, health, and pension in that yellowish segment improved just about 2.7% odd from 1.06 billion to just about 1.09 billion. Property and casualty results in terms of profit before tax contribution also improving just about 2%. From 302.7 million to 308 million. And of course, asset management improving around 34 to 35% from 43.8 million in terms of profit before tax contribution to 58.9 million. So certainly in terms of its major segments, we can see that there was consistent improvement across for Guardian at an operating level. Now, from a book value perspective, which is a measure of the tangible value of the net assets of the organization or the company, we can see that there has been a consistent improvement since fiscal 2022 from a book value of $12.62 at the end of fiscal 2022, more than doubling to $27.62 at the end of fiscal 2025. Now, the share price has not gone up in a commensurate fashion over that period. In fact, it has gone the other way. And that has resulted in that price-to-book ratio declining from 2.1 times in that fiscal 2022 period, consistently down to just about 0.5 times right now. So roughly, or loosely interpreted, the investors purchasing a share of Guardian Holdings at this particular point are paying half of the value relative to the net assets on record of the company at this particular point in time. So is that one measure of value? Perhaps. At a price of $14.75, Guardian is trading at a price-to-earnings ratio of 3.9 times, well below that sector average of 20.4 times, and offers investors a quite attractive dividend yield of 6.2% in any particular environment, which is pretty much in line, actually, with this sector's average of 6.1%. So with those high insurance revenues in mind, an appealing dividend yield, attractive price-to-book multiples, but of course with one eye on economic or fiscal uncertainty, certainly that asset tax on insurers and banks in the Trinidad and Tobago jurisdiction. Bourse is maintaining a market weight rating on GHL for the time being with a watch outlook. Turning very quickly to NCBFG, and for its first quarter of fiscal 2026, well, the group would have reported an earnings per share figure of 4.7 cents TT equivalent, which was a 3.7% decline from the 4.9 cents recorded in that prior comparable period of 2025. Net income from banking and investment activities declined 25% from 1.52 billion TT equivalent to just about 1.14 billion TT equivalent. Operating expenses declined also from 1.245 to 1.17 billion TT equivalent, and ultimately profit attributable to equity holders declined 3.6% from 118 odd TT equivalent million dollars to just about 113.7 million. Now, when we take a look at NCB's operating profit in terms of contribution by activity, it was somewhat of a mixed bag. life and health insurance and pension fund management, that particular segment down is just about 10% from 357 million. TT equivalent is just about 322 million. Wealth asset and management up around 36% from 58 to 79 million. General insurance down 40% from 99 to 60 million TT equivalent, and treasury and correspondent banking down around 8% odd from 142 to 131 million. So certainly more of a mixed bag in terms of results for NCBFG in its first operating quarter of fiscal 2026. Notwithstanding that, NCBFG's book value continues to grow consistently as well, growing from, in the first quarter of 2023, book value of $2.35 per share to $3.39 per share. And of course, the current price is around that sub $2 level. And that has resulted again in a consistently declining price to book ratio at around 0.6 times. That actually makes NCBFG on the banking sector the most relatively attractive banking stock, using the price to book measure at 0.6 times. Of course, the banking sector average of 1.1 times, with Scotia on the other end of the spectrum at just about 1.7 times. So at a price of $1.97, NCB is offering investors at this particular point in time a current trailing price earnings ratio of 4.9 times, which is well below that sector average of 9.1 times, and offers investors a dividend yield of 4.3% on a trailing basis, somewhat below the dividend yield of the sector average dividend yield of around 5.6%. So with those lower banking and investment results in mind, attractive price to book multiples, however, keeping an eye on that hurricane-related impact, and of course, similarly, market and fiscal uncertainties, particularly for its subsidiary, which could have an impact on overall earnings. Bourse is maintaining a market weight rating on NCBFG for the time being with a watch outlook. Well, that's it for this week's edition. For more information, you can give us a call at 2BORSE or 226-8773. Email us at info@boursefinancial.com. And of course, you can check out our website where all of our research is absolutely free at bourseinvestment.com. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.